Hello there and welcome to NCBA Money Mastery, where we teach you how to make your money work for you. My name is Daniel Macau. I'm excited about numbers that matter to you. There are some numbers that matter in regards to earnings, saving, and investing with NCBA. Currently, we have 33 billion shillings in assets under management, with a 30% annual growth in client numbers and assets under management, and over 5,000 clients investing through NCBA's investment bank. But am I investing well? Do I have a solid grasp of financial decisions? Am I living within my means? These are questions that we grapple with every day in the quest for a healthy personal financial status. While there is no set definition for a good personal finance status, there are many indicators that point in the right direction. This morning, we would like to show you ways you can gain mastery of your personal finance by putting in your hands tools that will give you mastery in handling your earnings, savings, and investments. My guest today is Paul Gicheru, Executive Director and Chief Investment Officer, NCBA Investment Bank. Paul, welcome to Money Mastery.
Good morning, Daniel, and thank you for having me.
So Paul, as we kick off, perhaps you could tell us what are the characteristics of somebody that has mastered their personal finance?
Thank you, Daniel. Certainly, there are many characteristics of someone who's mastered their personal finance, but I'll probably give a few just to give us a feeler. One, this would be someone who is not living paycheck by paycheck. This is someone who most likely have diversified their sources of income, most likely not depending on one source of income. This could be someone who's actually not borrowing from either a bank or a Shyrock to actually meet their day-to-day living expenditure. And so they've mastered their living expenditure. And most likely, then they're not, what I'll say, stealing from their future to survive today. That's what I'd call a successful person in personal finance.
All right. I think definitely people looking and thinking, well, I don't fit in that category. And they're wondering, I'd like to start, but where do I start on this journey to personal finance?
Daniel, it's an easy yet a confusing journey at times. But the journey to personal success, as far as finance is concerned, is actually started at the point of earnings. So your earnings are what you make from whatever you call your hustle. Could it be employment? Could it be your business? So once you ascertain what you're earning, then the journey you take after that is what will lead you to either success or failure as far as personal finance is concerned. And then after that, then it gets to how do I spend my money? And what we want to do today is to sort of give guidance as to what one could consider as far as managing their personal finance is concerned or spending. Certainly, it's not a one-size-fits-all kind of a plan. Also depends on so many other factors. But there are rules that have worked for other people in the past as far as spending is concerned. And one, and most important, is restricting your spending on necessities to 50% of your income. So if you're a monthly income person, then a maximum of 50% should go to your necessities. In this case, necessities includes right from paying your rent or mortgage if you have one, doing your commute, and living, food and health. Those are the basic necessities that you take 50% of your income. Then after that, you should you're left with 50%, and then other 50% you should first set aside 20% that goes to your savings and investments. And this is something that we should try to, as much as possible, do religiously. Make sure that you're putting some money away towards our savings. Then you're left with 30%, which we say is your discretionary money. Discretionary here is where you exercise some sort of discretion to decide, do I spend it, do I save it, or do I invest it? My idea would be, or my advice would be, for these discretionary amounts to look for the most logical way of increasing the amount that goes to savings all investments and reducing what goes to discretion. Discretion for us in terms of spending will be things like entertainment, gifting, and all those things that we do that could actually be, done away with if we decided. So to be a victor in this process, we'll probably say out of the 30%, can I only spend 5 to 10%, and the other 20% then increases my saving and investment kitty. The idea here is at any point in time, always balance your current living expenditure toward and your long-term financial success. Thank you.
All right, thank you, Paul. And that's a very interesting breakdown. But my question now is, now that we've broken down spending, what happens next?
Good. Thank you. Once you're done with figuring out what your spending will be, and sort of, in this case, you'll end up with a high-level budget of your spending, and so we'll also have a high-level understanding of where your money goes. Then what I suggest is then invert, the plan. So that instead of starting with the spending, then you start with the saving and investing. So that for every money that comes to you, the first thing will be to get out the 20% that ought to go to investments and savings. And the best way to do that is sort of create maybe a standing order arrangement where that money never even gets to you. Just like the way for those of us who could be employed, your employer would do. They first take the first 5% and take your pension. It doesn't hit your account at all. So create a structure that ensures that the first 20% is removed from your income immediately. Somehow over time, then that falls off your income. So then in your mind, you then are left with the 70% that you have to, utilize in other ways. Now, for this 20%, then the next important thing is to ask yourself, where am I taking this money after I set it aside? Definitely not under your mattress. I think that's the old saying, and definitely not in your current account. Putting it to your current account tells you it's not earning a cent, so you're losing the purchasing power of that money. And most likely a new need will show up that will make sure that you're spending that money. And you're not engaging that money in creating a good future for yourself as far as finances are concerned. So what I'll suggest is that then that money should go to meaningful investment. And this is how I would look at it. I'll say the 10% of that money goes towards my retirement kitty. Retirement is a lesson that we most likely always ignore so long, but as sure as day, retirement will come, and so we need to make sure that we're putting aside enough money for retirement when it happens. Then the other 10%, I look for other investments or mix of investments that will keep that money earning some money. So that can also be driven by the objective for which I'm saving the money. So if I'm saving the money, in this case for a rainy day, then I'll need to keep that money in an accessible structure that's still earning a return. So think about it. We always told save 6 months of your living expenditure in a place you can access it. And I think COVID has changed the lesson. We probably need to save up to 12 months because we realized it's very close to actually go. I mean, it's very easy to go out of income in a very short period of time. So that money, the first amount that needs to be for your living expenditure or emergency reserve should be kept in a safe investment. So not a very high return investment, but an investment that makes sure that somewhat you're meeting inflation and you can access that money as and when you need. But the other portion should actually start going to look for what we call investment return. Investment return here is return that most likely will beat inflation and that will put you in a place where you can actually start either diversifying your income sources or actually start the long-term journey of creating wealth. Generally, the idea here is to make sure that whatever happens every month, some money is going to savings, and that saving is not sitting idle. It's actually deployed to meet a need and can provide for you as and when you need. Thank you.
Well, thank you so much for that, Paul. Some good habits there. But my question now would be, what are the bad habits that you've picked up over time where personal finance is concerned?
Well, I think I would prefer not to call them bad habits, but maybe call them missteps, because all of us handle finances differently. I think there's a reason actually it's called personal finance. It's about me, not about the rest of us. But there are some missteps that sometimes we make when we're talking about looking at our own finances. One of the missteps is actually, I said earlier, living beyond your means. Living beyond your means generally will mean at the end of the month, I might have to look for a relative I have to look for a Shylock, or I have to go to my bank and ask for some bit of money or an overdraft to actually meet my living expenditure. Now, if there's anything that then sinks us lower and lower as far as personal finance success is concerned, is actually that chance that you'll actually be borrowing to meet your living expenditure. And that means you've not taken time to master your expenses or even eliminate what could actually be eliminated, or you're probably living in quarters that are not, that are not within your reach. Remember, we've been told time and again, if your rent, for example, goes beyond 30% of your income, you're probably living in spaces that you ought not to be living. So some of those are the evaluation you need to make. If you're spending so much on your vehicle, for example, you ought to think about it. Some of those things are things you need to look at. Then the other thing that I've seen is at times we take too long to transition our savings into investments. So this could be that I took money, put in my current account or savings deposits, all a money market investment, but then I never move that money into a place where I start taking some bit of a risk to actually create the potential to multiply my return. And return, in this case, comes in the form of either you are getting additional interest income, either that interest income is being reinvested and creating a very important aspect we call compounding of return, or you're actually starting to make capital gains. That could be from your business or could be whatever you are doing. So transitioning from investments, rather from savings into investments, is something that some of us take too long to do, and probably do it when it's a bit too late. The other thing is investing without conducting due diligence. So I keep aside all my hard-earned money, but then the process of investing becomes a challenge. That I'll either go for something that I've not done some meaningful research on, or maybe follow trends, what we call fund investing. So I'm looking for, what are people doing and investing in it. And that's why you probably see lately there's a lot of talk about cryptocurrencies, investing in land, and all those kind of schemes. Some people or some of us are not able to do the due diligence. So important that every time I'm about to invest into anything, I conduct the right level of due diligence so that I know whether there's a risk of capital loss. If there's no risk of capital loss, I know the kind of return I would expect from that investment. And then, of course, the other important is that of the one of forgetting that soon you shall be retiring. I think, as I said earlier, sure as day, retirement is coming and coming soon. What will happen the day I retire? How will I transition into retirement? Those are the kind of, some kind of the missteps that I've seen as far as finances are concerned.
Well, thank you, Paul. You talked a lot about investments, and my question then would be, for a person that's looking to make this decision, what are the products, what options do they have for investing as an individual or even as a group?
Good. Yeah, I'll talk about investing generally, and knowing very well that, of course, the suitability of investment sometimes depend on the stage at which you are as far as your wealth creation journey is concerned. Some of us could be at the starting point where we are saying, now I need to start. Some of us could have progressed quite well and somewhat have accumulated a bit of investments. And others are actually what we'll call successful, that they have investments that are already working for them in terms of generating a return, diversity, and actually, a peace of mind. But just to give general indicators as to what one could consider across the range, of course, we are all aware that banks at the first instance will give you fixed deposits that we are very familiar with. They'll give you savings accounts that we are very familiar with. So won't overstate the value of those. But in addition to that, the capital market space in the Kenyan market is developing and giving us a lot of passive investment structures that we can actually use. Investment that don't require you to be running up and down to actually generate a return. And the first one I think about is what we call the unit trust funds that are being offered by many fund managers within the market. Unit trust funds are regulated investments that the Capital Markets Authority has allowed fund managers to issue. And giving an example of what NCBA is doing, at NCBA, we have 3 unit trust funds that can give you an investment vehicle. We have a money market fund that's very low risk investment invested in interest earning securities and keeps your money fully accessible as and when you need it. We have an equity fund that gives you exposure to the stock market without you needing to actually analyze any stocks. We have a dollar investment fund for people who are looking to have some bit of their investments in dollars, looking at the expatriate community here, the diaspora, and even Kenyans who've decided I need to have some bit of currency, currency diversification as far as investments are concerned. Now, the way those three investments are structured is to ensure that they can be accessed by the at very low tickets. So the money market fund, the equity fund are accessed for as low as 5,000 shillings on a monthly basis, or whatever frequency that one chooses. The dollar investment fund, on the other hand, is structured to actually give access to someone for as low as $100. So around about equivalent of 10,000 shillings. And for that, you start earning a return and have that money still available for your use as and when you may need. Then on top of that, we can provide access to government securities. Now, if there's any space that individual investors are underutilized in the Kenyan market, is actually investing in government securities. So we are not taking advantage of treasury bills offers. We are not taking advantage of treasury bonds offers. Treasury bills are short-term borrowing securities by the government, while treasury bonds are long-term borrowing securities by the government. Now, what you realize that treasury bills give you certainty, absolute certainty in terms of your money. Actually, call it the lowest risk investment in any jurisdiction or in a country. Treasury bonds, on the other hand, start giving you return enhancement, getting returns in the double digits, and at times giving you what we call a tax advantage. Tax advantage in some of them will come without taxes, and others will actually come with moderated taxes. You may know that if you buy a deposit right now with a bank, the government charges you 15% withholding tax. If you buy a treasury bond, you can buy what we call infrastructure bond that pays 0% tax, and a taxable bond that pays 10% tax. You can imagine how the combination of such investment then reduces your tax burden. And then, of course, we can expose you to the stock market by directly buying stocks on your behalf, and can also take you offshore to buy offshore investments if need be. Of course, subject to limitation as to amounts that you can go for. Then, of course, for the more accomplished type, we can structure very tailored portfolios for you, and we manage them on your behalf. So those are some of the passive investments we have at NCB and available across the market, which I'd encourage all of us to start thinking through. Thank you.
Right, thank you, Paul. You mentioned all of these products. Now, how do I know? How do I know the right one for me? How do I know that the choice I've made is actually the right one for me?
Good. A very important question. Of course, as I said earlier, due diligence is very important in terms of how we approach investments. Picking the right investment can be quite daunting at times, especially so if you're not having the right level of information, or you probably don't have the right understanding of those investments. But I would probably give two initial rules that one should always look for when you're buying an investment. One, the investment should actually give you a peace of mind. And like we always try to say, if I can invest and not sleep at night, or if I invest and I cannot sleep well at night, maybe that's not the right investment. Why do I say not sleeping well at night? It's possible that you can take all your money and go and buy a speculative investment. And so every 2 minutes, you're trying to look for the source of information that can tell you whether your value has gone up, gone down, or if you actually lost the investment. So limiting your investment, or rather concentrating your investment into one investment, or failing to diversify, can actually cause you sleepless nights. And that's probably not a very good way of investing. Two, it will not be an investment if it doesn't somewhat beat inflation. Inflation is a very important number, and it affects the purchasing power of every money you put aside. So if it doesn't beat inflation, it's probably not a very good investment. And so it's always important to ask yourself, where is inflation vis-a-vis the return I'm likely to get from this investment? And then, of course, there's another criteria that we use to look at these investments. One, does it meet my objectives? My objectives could be, to pay my school fees next year, to save for retirement, to buy a car next year, to buy a house over time. So those are very timed objectives and require specific amounts of money. How likely is the investment I'm going for likely to meet that objective? If that objective cannot be met, then most likely I'll not get it right as far as that investment is concerned. So very important to define that. And then the risk that investment portends as far as my overall wealth is concerned is very important. So I first look at myself and wonder, am I the risk-taking type, or am I the conservative type? If I'm conservative, I'll make sure my investment speaks to my risk appetite. And of course, I'll adjust that to my ability to take risk, because as I accumulate wealth, then the ability to take risk also improves accordingly. So I need to make sure that that is balanced over time. Then is it meeting the liquidity requirements that I need? Liquidity is, for example, if I buy an investment and I'm retiring or close to retirement and I need to get access particular amounts of money every month, does this investment give me that ability to access that money? I don't lock in money where I need money to come at a particular frequency. Then, of course, as I say, is tax efficiency. So can I look for ways of reducing the tax burden that I'm getting from these investments? So that, one of the best or the biggest way that investment return is reduced is actually the tax that you're paying to the government. But we know the same government has given us opportunities to actually invest in more tax efficient ways. So whatever investment I look at, then I have to ask, what is the tax implication of all that? So we know, for example, if I invest in stocks, dividends are subjected to tax at 5%, but capital gains are not subjected to tax. So can I look for a way of them combining these two so that I'm actually reducing the tax burden? I talked about bonds earlier. How can I combine different assets to actually give me a low tax burden as much as possible? We don't like paying taxes, and I think that's across board. But we have to ensure that we don't pay taxes within within the regulatory framework. Those are some of the considerations I'll say you could use to determine whether investment is suitable for you.
All right, thank you for that, Paul. Now, one of the ways that's very popular in terms of investing is in a group or what we call chamas. And the question then I'd have for you is, what is the advantage of investing as a group as opposed to investing as an individual?
Good. Daniel, I'd say both ways are good and eligible, and of course, depending on circumstances. There's some reasons that one may decide to go as an individual. There's some reasons you may want to go as a group. But there's a popular saying that, if you want to walk fast, walk alone. If you want to walk far, then walk as a group. Obviously, that gives credence to actually investing as a group. Now, one advantage I see of investing as a group is actually the value of the one due diligence and, of course, economies of scale. Due diligence comes about in that when sometimes I'm making a decision as Paul, most likely my emotions and likes and dislikes overcome me and end up making decisions on the basis of that emotional aspect. And so that may limit the extent to which I query or interrogate investments. But when we come in as a group, there is always that voice of reason or someone who actually thinks different from the rest of the group that tells you, let's think about these other elements. And most likely than not, that's probably the thought process that you needed to actually get away from a risk that you cannot live with or actually get a good investment that you can look for. So due diligence improves. Of course, speed of decision making may be reduced, but if one balances that off with the value of actual due diligence, then I would say it's good to invest as a group. Then the other aspect, as I said, is economies of scale. Certainly many investments that we cannot access with our small savings. But those investments can be accessed, by coming together as groups. I mean, think about very big investment houses that we have in this country. They were built out of group effort. People came in together and were able to access investments that hitherto could not have been accessed by any single person. So those are the twin advantages that we get for going in as groups. And that's why then the chama or the investment clubs, mindset in Kenya is a very important way to go.
All right, Paul, I'd like us for a minute to talk about risk. Today, there are lots of products out there that promise phenomenal, extraordinary returns. And the question I have for you then is, how do I know that I'm picking the right investment partner?
Good, a very important question, and especially so in the current times, because some people have lost money because we were promised returns and those returns were not delivered. Of importance is to have a clear understanding that for every percentage return, there's a risk implication. So you cannot earn a return without taking some bit of risk. And that risk could be in the form of I could lose the money, or I could not predict, the kind of return that investment may have. And I mean, the element of lockup. if our money is not available to me every day, I cannot touch it every day. That's also portends a bit of a bit of a risk. So what I'll underscore here is the importance of us to then ensure that for every investment we are going for, we have actually thought about the risk element. There's a reason two money market funds may be earning different returns. One, because maybe one of the fund managers could be very conservative and the other person could be more aggressive, or one person has gone for higher risk investment compared to others. So what I always say is that it's good to question your fund manager. Even when you come to NCBA, it's good to question us, where are you deriving this return from? So that from the onset, then you're able to ask yourself, am I comfortable with the kind of risk the fund manager is taking as I invest? Have I understood the likely payoffs of the investment I'm taking? If sometimes we for the allure or the double-digit return or high return that you're getting, we sometimes fail to conduct the right due diligence. So my point will be, let's take time to analyze those investments. Let's consult, let's discuss with whoever is providing those investments. And then from there, you make a decision. So identifying reputable investment managers, reputable partners is very important, so that that they are giving you the right information you need to actually make the right kind of decisions.
Thank you so much, Paul, for that. And there's so much information you've just shared with us the last few minutes. And I imagine there's somebody there who's saying they're ready to invest, but there's all this information. It's daunting. When you, as customers, do you hold our hands? What happens? How do you help us make the right decision?
Indeed, we try to ensure that when you come to us to make any investments, then we have the right handholding structure. Just giving an example, of course, you may be aware that we have a customer service team, a contact center, and client service officers who actually speak to our clients as far as concerned. So every time you come to us and are proposing to do an investment, I would encourage everyone to always speak to one of our client service officers who will indicate to you or advise you on exactly the characteristics of every investment and how that into the overall investment structure. If you're going for stocks, then we can actually have our team talking to you about various investment industries that you can get, various companies, and the likely outturns as far as these investments are concerned. So as you do those investments, as you come to us and as you try to engage with some of these investments, just try to ensure that you speak to any of our in some of the contact center. They'll put you in touch with the right person who will advise you or will help you with before you make that investment decision. We are happy to do that and are always happy to engage. So frequently we release information about the markets that gives you a chance to actually understand the overall structure of the market and what's happening, and then that can advise you in what likely trends we'll have as far as investments are concerned. Thank you.
Well, thank you so much, Paul. So now, ladies and gentlemen, we'll be taking a short break. But when we get back, we'll be looking at how the link, rather, between your investment choice and your credit score. So please look out for that. And please keep your questions coming. We've seen lots of questions coming through, and Paul and I will be tackling them just after the break. Stay with us.
I brought you a small bonus.
Bonus for what?
Daddy said you helped us get a house, a car, and Mommy's business.
But I only helped them get the loans.
You did more than that. You got us 299 family dinners, 64 kisses on the cheek, 12 road trips to see Grandma, 42 jokes from Daddy, 49 laughs from Mommy.
In over 60 years of dealing with numbers, we've learned that the numbers that matter the most to you are the ones that matter the most to us. NCBA Bank. Go for it.
Welcome back to Money Mastery from the bank that says, go for it. I have been speaking to Paul Gicheru, Executive Director and Chief Investment Officer, NCBA Investment Bank. So Paul, is there a link between my investment choice and my credit score?
Good, a very important question. Yes, there is actually a link between what you invest in and your credit score. And I'll probably give an example as to how we handle this at NCBA. So every time you invest at NCBA, be it a fixed deposit, a savings account, money market, whatever you talk about, then that investment accesses your eligibility to actually accessing a loan at NCBA in the format that it will become a security for your borrowing. So the bank admits all those investments as security for borrowing. Of course, that will be admitted on the basis of understanding each of the investments. So, for example, an investment in a treasury bill, fixed deposit, treasury bond may be eligible for higher level of borrowing as compared to an investment in the stock market because of the risk that underlies that. And banks will call that loan to value ratio. So what loan am I willing to give up against the valuation of that, that investment? And secondly, obviously, because you are providing a security, and to some extent a security that we understand and have access to, then of course you get a better chance to negotiate with the bank in terms of the kind of interest rates that you may be borrowing at. So that is boosting somewhat your credit score and ensuring or making easy access to loans. In addition, all this perfection process of this investment is actually very easy. And how we do it is, if investment money market fund, it just takes a confirmation to the bank that we have that investment, and then agreeing with you that we put a lien or hold that money on behalf of the bank to actually provide security for the bank. If you compare these two, for example, giving the bank a security like a car, bank a security like land, then you will actually see the speed at which then this is accelerated in terms of how you can access, that loan. So your credit worthiness and the credit capacity is actually way enhanced if you have these investments with us. Thank you.
Right, thank you so much, Paul. You've shared such a wealth of information there. And now I'd like us to take a few moments to tackle some of the questions that have come through from our audience through different social media platforms. I'll start off with one from a handle at Brain Olamide KE. He's asking, how should I invest? I always save money, but in the end, I run out and I'm broke.
Good question there. I think it's not a challenge to him alone. I think all of us are going through this challenge at different times, and especially around this time, because needs are increasing, incomes are coming down, and so many factors are coming into play that affect how we manage our finances. But what I like about him is that he says he actually of saving. So that means somewhat he's figured out that he needs to save, which is a good, a step in the right direction. But the challenge he's having is that over time, then he's having to plow back his savings into his spending. And so that takes me back to the initial conversation we were having around, setting some rules of thumbs as to how you spend. The most important thing here, and I would advise, is I would tell him to go back through his list of what he's spending on and try to figure out where is this money going that's actually being plowed back from investments. So that if, for example, that money is going to meet your rent expenses, is going to meet your entertainment expenses, then you might want to look at those lines of spending that are causing you to shift from your initial plans, to actually ending up spending your own savings, because that is what will keep you, will keep holding you back from actually now transitioning from savings to actually real investments. If you master the spending, then most likely you'll actually be able to ensure that consistently the money that needs to go to savings is actually going to savings. Often you'll actually realize that there are probably discretionary costs that were coming your way that you would have managed differently, that you are not managing. And so that challenge of actually going through and ticking the box, or rather ticking through the expenses, would help you restart the journey of consistently saving. Thank you.
Right, thank you. There's a question coming through here. The question is, what is the best place to invest 100,000 Kenyan shillings for a 20-year-old?
Good. Thank you. So remember I talked about the objective of the investment. So one of the guiding criteria as to where you should put 100,000 shillings would be, what is the objective of this investment? So that if the objective of my 100,000 shilling investment is to pay my school fees next term, then I'll need to put that money in an investment that I can access next term. If the investment is about my retirement, then I'll need to invest in a structure that will ensure I don't access that money until I get to my retirement age. So that I'll be looking for a pension fund investment, for example, or an investment that ensures that somewhat there's meaningful level of friction in terms of accessing that money. But if I'm investing for other objectives, I'll first define what that objective is, and then I'll look for a combination of investment that I can go get into. So for example, if I just wanted to start the journey to growth, what I'll look at here is that journey to growth may be pursued over 5, 7, 10 years. If that journey is about 5, 7, 10 years, then I'll say out of these 100,000 shillings, I'll put some bit of that money into growth. And I might say 60%, 70% of that money will go to growth. And for me, growth may come in the form of buying, say, stocks, for example, all equity funds, all bonds, which will give me a double-digit return most likely over that period of 10 years on a per annum basis. And the other 30,000 rather, I'll put into an investment that can be very accessible. And this for me is to make sure that I have something that I could run to on a rainy day, because rainy days are happening every day. I think COVID has probably been the best lesson around these matters. So I put aside 30,000 that can be accessed fairly quickly. So in essence, and I'm saying if the main investment is earning, let's say 12% on average, and the other investment is earning a return of say 8%, so averagely maybe my return is about 10%. Now that 10% gives me an indicator that I'm growing my wealth. And if I may talk about a rule we call a rule of, this rule tells us if I take 72 divided by the return I'm getting on that money, it gives me an indication as to by the period it will take me to double that money. So for example, in this case, earning 10%, if I take 72 divided by 10%, it tells me in about 7.2 years, I'll have doubled the money I started. And then in that case, after another, by the 14th year, the money will have grown fourfolds. In essence, if then I'm looking to do growth, then I can easily predict based on the investment for where that money can take me over that period of time. Those are the important considerations I'll make before I decide where to put that money.
For that very comprehensive response. I'm sure it's helping more than just the person who's asked the question. Our next question is from Keith Njiru. He's asking, what exactly are money market funds?
Good. Thank you for that question. I'll use the analogy of the typical chama that we're used to describe a money market fund. So how do we form chamas? We form chamas by coming together as individuals, put that money together, and then from there, decide how that money will be invested. So as individuals, we probably come with different paying capacities. So one will come with 5,000 shillings, one will come with 1 million, and all that. So the idea here is individuals are coming together, putting the money in a kitty, and that kitty is invested to generate a return. And in turn, that return is distributed to the investors on a regular basis. So the way the money market fund is we've created a chama, in this case for NCBA, for a chama of 5,000 people. That money has been put independent custodian just to make sure that that money is not misappropriated. And this custodian is regulated by the central bank and the Capital Markets Authority. That custodian then works with someone called a fund manager. The fund manager, who in this case is what NCBA Investment Bank performs, makes investment decisions on behalf of that, that kitty. Those investment decisions may entail, can I buy this investment? Can I buy that other investment? And of course, within the framework that the trust deed of the money market fund has provided. So every day you can imagine these investments are accruing a return. That return then we distribute to you. Distribute in this case, as we say, the return can be available to you, but we prefer to avail that return to you at the end of the month. So at the end of the month, you may come and say, you know what, the return you've earned, say 30,000 shillings, I want to draw it out and go and spend because that's what I spend for my living expenditure. Or I want you to reinvest that money. Reinvesting means you start creating the compounding effect I was talking about earlier. Now, the good thing about money market funds is that they operate under a very highly regulated environment. So Capital Markets Authority have set up rules as to how we should operate money market funds. And so there are rules that we have to follow as fund managers. There are rules the custodian has to follow. And then overarching the two providers, there's someone called a trustee. This trustee has the responsibility of ensuring that the two service providers keep your money safe. And all of us then report to the Capital Markets Authority, who will vet that we are actually doing and delivering what we have promised. So that is how the money market fund works. In our case, that distributes a return every day and has been giving a very consistent return, averaging about 8% on a per annum basis. And the access level for 5,000 shillings for the money market fund. Thank you.
Thank you so much on that. With regard to the market funds, there's a question that's come through actually from two people, Faisal Hanif and Christine Rubin. They're asking, what's the best income range to get to before you start investing?
Good. I'll say there's nothing like the best income range to start investing. Your investment should actually start when you start making money. And so some of the lessons that I would have wished I learned when I started making my first income is that I needed to immediately, or actually investing immediately. There is nothing equal numbers to where you should start. Because remember what we started. We started by saying these are the spending rules of thumb that you should consider. So some of that tells you from the beginning, 20% should have started going to savings. That 20% for someone earning 10,000 shillings is 22,000 shillings. For someone earning $1 million is a lot more money. But because the market offers various places that you can actually start investing that money in, then there's nothing that should hold anyone of us back in terms of starting the process. The sooner you start, the better. Indeed, that should have started yesterday. If we didn't start yesterday, then it should start now for whatever level of income. Thank you.
All right, thank you. There's another question that's come through. And the question is, will buying an apartment to let out on bank financing give me good returns, and how long will it take?
A very valid question. I think a question that we've been grappling with, especially so because we have a market that really respects real estate. Now, this is how I put it, and I think a lot of advice is always required as you go about purchasing or invest estate. If you're going to use bank finance to actually buy an apartment for the purpose of renting out, then it is important that you do the right kind of calculations at the beginning. Calculations to help you understand how much am I likely to be paying on this apartment on the loan, and the insurances that comes with it, and how much am I likely to be earning from this investment from the beginning. So let's give an example here. If I have to go to the bank and borrow at the rate of 20, let's say 12%, just for for calculation basis, 12%, and borrow 10 million shillings. I invest in an apartment, and then when I work on the rent that I'm getting from that apartment, the rental yield I'm getting is probably say 6% or 7%. And rental yield here is if I take the total rent income minus the cost of sustaining that property divided by the price I paid for that property, is what we're calling the rental yield. So, for example, that comes to 7%. So, asking myself, how am I bridging the gap between the 12% I'm paying to the bank and the 6% I'm earning? It could be bridged in two ways. One, you could have another source of income that's supplementing that, or maybe the appreciation of this property, if you're holding it as an investment property, could actually be covering that gap. But it's important that you actually ascertain how those parameters are working before you actually commit to borrow. But it's also good to be conscious that one, as time passes, the loan will be reducing, and so the interest expense you are paying on that loan may be coming down, while the property value may be appreciating. So those numbers may be crossing. And so with the right kind of advice, then we can actually be one can actually be able to decide whether it's a good decision or not a bad decision. But I would say generally that will be helpful. Yeah.
All right, thank you. We'll take one more question coming through from Facebook from Adina Grebovic. The question is, can you please give some more information about investments which are tax-free?
So what I'll do, I'll give two examples of investments that are tax-free in the country. Of course, most of the investments in every country will be subject to taxes, and we know government are financed through taxes, so they look to optimize the returns, the taxes that they're getting. But especially in Kenya, I'll give two examples of investment that are tax-free. One, there's what we call infrastructure bonds. These are bonds issued by the government. They are long-term in nature, but also have a secondary market where we can sell amongst each other. Those investments come at zero tax. So if you get a return on investment of, say, 12%, that is your money. And so just recently, they issued a bond that has 18 years to maturity, but of course with a secondary market, so you can sell it if you get tired of holding it or you need to exit, but it's earning a return of 12%. That return comes to you tax-free. Of course, eligibility, you can go to central bank and those for as low as 50,000 shillings. For example, capital gains. If you earn capital gains are not subjected to taxes. So if you buy Safaricom at 20 something and then yesterday you sold it at 11 shillings, was not subjected to taxes. It's your income to the end. And so we need to be considered time and again. I think just recently actually 2 years ago or 3 years ago, the bank launched what we call Emakiba, where you can use your phone to buy tax-free bonds from the government. These are advantages or places that I would encourage all of us to start perusing so that we can take advantage of those opportunities.
So much. There's a question, another question that's come through. I think we've lost it, and perhaps it's time to wrap up. Thank you. That's all we have time for on this edition of Money Mastery Conversations from NCBA, where we teach you how to make your money work for you. To learn more about our products, please visit our website at ke.ncbagroup.com, or better yet, call the numbers that are scrolling on your screen. You could also like, follow, and subscribe to our social media handles on the screen right now. Till next time, when we bring you another set of numbers that matter to you, my name is Daniel Macau. Goodbye and keep safe.